Well, good morning, everybody, and thank you very much for being patient with us whilst we get started this morning. Welcome to our webinar in our series of Meet the Experts. And joining me today are Lisa Walker, Head of Market Regulation at IPSX, Sonya Vidiartkhi, who's Manager of Equity Capital Markets at IPSX, and Izzy Roberts from Simmons Simmons. Good morning, Lisa.
Good morning.
Good morning, Sonya.
Good morning.
And good morning to you, Izzy.
Good morning.
So today we're going to be discussing the process of getting ready for an IPO on IPSX. And arguably this is perhaps one of the most important areas for the exchange. So I'm delighted to have Lisa, Sonya and Izzy with me today, who will take us through exactly what preparations are needed for an IPO to be successful on IPSX. But before we get started, may I just point out that you can post questions to the team at any point during this morning's webinar by simply using the text box, which will appear at the bottom of your screens. You might just need to move your mouse to activate it, but it will appear. We'll take all the questions at the end after we have heard from Lisa, Sonya and Izzy, which should be in around about 20-25 minutes time. The webinar will then be posted up to our resources section on our website at ipsx.com, where you can listen to it and of course to all our other podcasts and webinars. So let's make a start. Lisa, over to you.
Thank you, Kevin. So if we start with the advisory community that supports the issuer as they come to market and use that as the beginning to describe roles, responsibilities and processes. So during this presentation, Izzy will talk about the role of the lawyers, who may also be lead advisors, and a number of the other advisors that help the issuer to come to market. Sonya will talk about the marketing and placement of securities, including the role of the book runner, and I will talk about the role of the exchange and the role of the regulator, the Financial Conduct Authority, in its capacity as the listing authority. So if I start first by talking about the specific roles of IPSX members who support the IPO. So the first two types of members here are advisory members and are critical in the process of bringing an issuer to market. So lead advisors provide expert advice on the admission process, and they liaise on behalf of the issuer with IPSX and with the FCA. They must be familiar with the rules of the exchange as they apply to issuers, as well as the rules that apply to them. They need to ensure that the issuer meets the admission criteria and that the issuer understands their ongoing obligations once they're admitted to market. So those ongoing obligations include both obligations to the exchange, such as requirements to produce 6-monthly asset valuations, and other public market obligations, including compliance with disclosure and transparency obligations and the market abuse regime, for example. They're also subject to the takeover code in the event of certain key transactions. In addition to the role that the lead advisor performs in respect of liaising with IPSX, lead advisors are also likely to be managing the relationship with the FCA or the UKLA, who review and approve the prospectus. The FCA would also consider any applications for admission to the official list, and a lead advisor may support the issuer with that. Some lead advisors may already be FCA approved sponsors and have the relevant knowledge and experience of the FCA processes. Lead advisors will also support the marketing and placement of the shares. The second type of advisory member that we have on the slide is the approved valuer. So these valuers must provide an RICS compliant Red Book valuation as part of the prospectus. And thirdly, we have market makers down on the slide. So they're not critical to the IPO process, but in order to come to market, an issuer must appoint a market maker to support and provide secondary market liquidity for the issuer's securities when they come to market. This ensures liquidity in the secondary market. So if I turn now to the eligibility criteria for issuers in coming to IPSX Prime, and I should emphasize that IPSX Prime is now open for admissions to trading. So issuers are eligible for coming to our market where they own and manage single commercial real estate assets, or where they are multiple asset issuers where there's commonality in the portfolio. In terms of asset size or value, there is no maximum size, but to ensure that the assets are of institutional grade, the assets must have a minimum market value of at least £50 million. There is no upper limit in terms of the value of issuers coming to our market. The issuer itself should have a minimum market cap of at least £25 million. There must be a minimum free float of 25%. And in order to ensure that the assets held by the issuer are of a value which is attractive to institutional as well as retail investors, we're looking to limit the loan-to-value ratio to 40% at the point of admission. As I'd mentioned, the FCA has a key role in the admission process, and that is particularly around the approval of the prospectus. And we will discuss that in the next slides. There are two other points which are worth mentioning around eligibility criteria, and these are optional for issuers. The first is around REIT status. So because IPSX has been approved by HMRC as a recognised stock exchange, if an issuer chooses to become a REIT, then we are able to, the issuers coming to our market will be able to meet the share trading condition. In addition to that, again, because of the status we've been granted by the FCA as a recognised investment exchange operating a regulated market, any issuer seeking admission to the official list can come to our regulated market, IPSX Prime, and will meet the obligation to have their securities admitted to a regulated market. So Izzy will now talk about how the legal and due diligence elements work for an IPO, including the role of the various advisors.
Thank you, Lisa. So I'll actually start with the two boxes towards the bottom and the bottom right, the investment story and the strategy. So you need to think about what you are going to try to say to an investor you are going to do with this asset and the company that holds this asset or assets. So important points there are, a model, a financial model for how that business will work. What is the historic track record? Do you have 3 years of historic numbers? And if so, they will need to go into the prospectus. If you are a large property conglomerate, which is not unlikely, and you are looking to float an asset or group of assets that you currently own, there's some thinking to be done around how much of that asset do you want to own going forward. So you don't float part of a building, but what you can do is the building will be held in a company, and the sort of seller entity, as it were, can retain ownership of a number of those shares and then potentially sell them in the future because the entire issued share capital of that company gets admitted to trading. But how much of it you want to hold on to is a key thing to be telling people who are going to invest, so it's something to be thought about. You need to have a think about the strategy for the asset or assets. Is it a fully let asset? Does it still need to be let? If so, what is the leasing strategy? When is it due to be redeveloped? How is it going to be enhanced? Or is it a building that is actually brand spanking new, top of the range building that you expect to have, that is fully let and is going to remain that way for about 15 years? What are you going to do at the end of that period? What are you thinking in terms of financing that? What are you thinking about in terms of returns and dividends for investors that might be available? And that's all sort of driven off that financial model piece. And if you go to the sort of top left-hand box, this is an area where the issuer's lawyers are really key, and it's the due diligence process. This, for those of you who are used to doing bilateral sales, is actually pretty similar, and it lends itself to dual tracking in the sense of you're not entirely sure which route to go down, a lot of this earlier prep phase on the diligence side is very much the same. You need to be creating a data room. You need to be, looking at title, certificates of title, planning, leases, key contracts, and all of those pieces that you would show to a buyer on a bilateral are just as important in the context of an IPO, because they all inform the content of what you say in the prospectus about, the asset and what you're saying to investors. And a crucial part of that prospectus process is the exercise called verification, which is a checking exercise to make sure that the statements that you make in the prospectus are true. And you can only do that on the back of some thorough diligence. That kind of leads into the sort of the top box and then the tax box. So you have to think about how the asset is currently held. Now, it may already be an asset or group of assets sitting in a single company that doesn't contain anything else, in which case that's great. If, however, it's actually pooled with a bunch of other things in your corporate structure, then it will have to be moved out into a company that's going to hold that IPSX asset or group of assets. And you may well end up having to get a brand new company to put on top in the context of, obviously you have to float a PLC. It's actually often a lot easier to stick a PLC on top of something than it is to convert a private company into a PLC, but either of those is available, but you need to end up with a separated entity. So if you have an entity that's kind of within a group, you need to think about what are the steps required to effect that separation. What is the tax impact of that separation? And get yourself in a place that you know how long it's going to take and what you need to do, so that on day one, once someone becomes an investor in this asset, if not before, it's a completely self-standing company that is not reliant on a parent for a bunch of things. It needs to be a little commercial company all of its own. The tax point, Lisa has already picked up the importance of deciding fairly early on whether or not you're going to be a REIT. The prospectus will also talk about the tax treatment of the shares in the hands of investors, and tax obviously features into the returns and the model that you create for the entity. Last but not least, governance. So this again is a crucial role. Your issuer's legal counsel helping you set this up, and also your lead advisor, and the lead advisor's lawyers will have views on this as well. You need to think about your board. Is it going to be a largely non-executive board with a property manager appointed, or is it going to be more of an executive board? Either of those is possible. You need to think about the right people to have on the board. They need to have the right balance of experience in terms of listed companies, finance experience, and obviously experience in the real estate world. You need to think about the processes and procedures you're going to have set up internally to make sure that you've got the right information flow up to the board so they can discharge their duties. And you need to, this is where this relationship with the seller, if you're pulling something out of a large group, is also very important, because property managers, significant shareholders are related parties under the IPSX rules, and doing transactions with them going forward can often require a vote. So that if you are going to have ongoing contractual arrangements, those should be baked in at the time of the IPO and disclosed to the investors. And it's very important that these entities are commercial companies rather than sort of mini asset, mini funds of one asset. So that is kind of how they need to be set up. All of this process can take a while, and then you lead into the, more of the actual execution phase, preparation of the prospectus and the other documents. And I'm going to hand to Lisa, who's going to talk you through the IPO timing.
Thanks, Izzy. So this slide talks about some of the key dates for admission to trading from an exchange and a regulatory perspective. So there are essentially three streams here, and those relate to the appointment of advisors, the submissions that an issuer needs to make to IPSX, and perhaps most importantly, the submissions that must be made to the FCA in their listing authority capacity. So about 2 or 3 months out from the time where an issuer would like to consider an IPO, they should think about early engagement with the FCA on listing eligibility if they are contemplating having their securities admitted to the official list. At around the same time, they should also submit an application form for an IPSX issuer. The purpose of this application form is to enable the exchange to undertake an initial eligibility check to see that the issuer and their securities would be eligible for admission to our market. And to support that process, it is recommended that the issuer appoints a lead advisor and an approved valuer and other advisors that will help them, as Izzy had mentioned, through that diligence process, and potentially also identify the market maker that will help them in providing liquidity in the secondary market. About 8 to 10 weeks before admission to trading, we would expect that the issuer has submitted their first draft of prospectus and the Red Book valuation to the FCA for review and approval. And at the same time, if they're looking to seek admission to the official list, the listing eligibility letter would be submitted at the same time. While that's happening, the issuer should also submit the same documentation to IPSX. We won't be reviewing and approving the prospectus. That is the role of the FCA. However, we will review the Red Book valuation to ensure that that meets the prescribed content set out in the IPSX rules. At this point, the issuer should also have identified their potential non-executive directors. And as Izzy has mentioned, the issuer should have particular regard to the skill set and competence of those directors to ensure that they're able to effectively oversee and manage the issuer. Now, around 10 business days after there's been several rounds of review of the prospectus by the FCA, we would expect that the prospectus will be approved. And any listing hearing at this stage would be booked and the listing application documents also submitted to the FCA. IPSX at this point requires the core issuer information requirements set out in IPSX rules to be submitted to IPSX. And assuming that the prospectus has now been approved, all of the core information has been submitted, we come to the last several days before the issuer's securities are admitted to trading. IPSX at this stage will need to see the lead advisor's declaration submitted that sets out their comfort with the material that's been submitted. The final form admission documents will be submitted to IPSX, and the market maker at this stage will have been appointed. And then we reach the point where the issuer's securities are admitted to market, having had their final form prospectus published. They've announced their intention to float, and as I mentioned in the bottom right-hand side of the slide, the shares will be settled on a T+2 basis after they've been admitted to trading. Sonya will now talk to the marketing, book building and placement elements of the IPO.
Thank you very much, Lisa. I think at this stage it is natural to talk about who will be the buyers of the product and who will be which investors would this product appeal to. As you can see on this slide, traditionally the real estate deals were marketed to a very narrow range of investors, usually institutional investors and sovereign wealth funds. IPSX now creates a marketplace which allows a wide range of investors to participate in the real estate arena. We're opening up the IPOs to a wide range of institutions, which now can include smaller mid-cap investors, high net worth individuals, family offices, and most excitingly, retail investors. On the following slide, we try to illustrate the result of the IPO being marketed to a wider range of investors. On the left-hand side, you can see the traditional demand structure of the IPOs on the exchanges historically. On the right-hand side, we demonstrate a much more diversified investor base, which includes, in addition to the usual participants, retail investors, wealth managers, private banks, multi-managers, etc. We believe that the issuer and the investors should be excited by this opportunity. We believe that the retail community will play a significant part in the IPOs on the IPSX. On the following slides, we want to demonstrate how the marketing workstream will work like and how the actual process of taking the IPO to these investors will look like. The key points to highlight on this slide is that the issuer at the start of the process needs to think about the syndicate and which banks, book runners they would want to engage with. Depending on the objectives, some of which Izzy mentioned earlier, so the envisaged size of the transaction and the objectives of the issuer will need to construct syndicates which optimizes the distribution and access to investors. There are a few things that the issuer needs to think about before giving the mandate to the book runners. These things include factors such as ECM experience, corporate finance experience, the strength of the research and sales franchise of the book runners, and of course the final team that will be dedicated to the issuer for the IPO. Based on the syndicate that is constructed, the book runners will arrange a few key meetings with select group of investors. This stage we usually call early look stage of the IPO process. These are market sounding meetings where the issuer will be introduced for the first time to the investor community. And the key output of these meetings is to gather crucial feedback, which will be used to determine whether the issuer and the advisors will be comfortable to proceed with the transaction. Based on that feedback, the issuers and the advisors will recommend a go, no-go decision, and assuming the market conditions and the feedback is of sufficient quality and quantity, the issuer will enter into the execution stage of the transaction. Execution means that the transaction is live and any investors that I've described earlier can now put an official order into the book via the book runners. The issuer will then go on to the road and meet the investors and present the prospectus to the investors, as well as a short presentation about the envisaged transaction. As the roadshow progresses, the book runners will start building the book of demand, and the investors will be putting forward their offer sizes into the book. As the book progresses and the book building closes, the issuer will decide based on the quantity of demand that the advisors received how to price transaction and how to allocate the investors. At that stage, the pricing and allocations occurs and the transaction closes and the shares are ready to be settled with the investors. I will now hand over back to Lisa.
Thanks, Sonia. So this slide really brings together all of the activities which happen as part of the IPO process, from the point where a company first contemplates coming to market to the point where the company's gone public and the shares are admitted to trading on a public market. At this stage, we'll open up the webinar to questions. Kevin.
Great, thanks Lisa, thanks Izzy, and thank you to Sonia. That was quite a detailed set of slides and presentation that you've all delivered, and I'm sure those that are on the webinar today will have found that to be really informative. So I'm pleased to say that we've had some questions that have come in. So what I propose to do is take those now, and what we're going to do is look at what other questions might be coming in at the same time that we take these. But let's kick off with these first, if I may. So let me just take this first question. Lisa, I think this one is probably going to be best for you to respond to. And it relates back to structures. The question is, how does the structural work of the organisation once the IPO has taken place? And further to that, who is then responsible for managing the asset?
Very good question. Thanks, Kevin. So in terms of responsibility for managing the asset, because this is a public company subject to company law obligations, the directors of the company will ultimately be responsible for running, managing and operating the company. So what that means in practical terms is that if they retain the management responsibilities internally, you will see all of those structures within the organisation. It may be that they seek to employ specialist providers of some of those services. So it really depends on whether you have, as Izzy had mentioned, an owner-occupier that might want to retain some of those responsibilities, or it might be that they find a third party who specialises in managing particular assets. So it really depends on how they've decided to set themselves out, structure themselves. If there are material outsourcing arrangements in place, those will have been described as part of the prospectus, and the directors in any event will retain responsibility for the strategic decision making of the company, and also will be responsible for managing and monitoring the outsource arrangements, and will retain oversight of the activities which have been outsourced.
Okay, thank you. Very helpful. Let's take our second question. Sonya, this one's coming to you. And this is a question really, I think, that's relating to the book building exercise that you spoke against. And I think it's probably a point around timing, but the question is, what is the process for book building? And perhaps you could just reiterate that point you were making earlier about the timing of that and where it fits in the process.
Yes, of course. Thank you. So I spoke earlier on the process timeline slides that one of the key elements of the marketing workstream is to collect the crucial feedback from the investors during the early look process. Once the issuer and the advisors gather sufficient quantity and quality feedback and the go decision is taken, the book runners open the book, literally the book of demand, to all their client base, and the transaction can be then officially marketed to the investors, any investor that would want to participate in the transaction. The announcement goes out to the market, and any investor that would be interested in meeting the company before submitting an order will request a roadshow meeting via the book runner. The book runners will hold a roadshow schedule. The schedule usually takes 2 to 3 weeks. In case the issuer decides to include a retail tranche in the offering, the book will be opened longer than 2 weeks, so usually 3. The roadshow meeting is usually a 45-minute meeting where the issuer presents the company, and investor will already have the prospectus, which will be available to the public. And based on that meeting, the investor can then put an order into the book via the book runner. Once enough orders are being collected, the book will be of sufficient quality, and the issuer will then take a decision on how to allocate the investors. Hopefully the book will be oversubscribed, and the issuer can then construct appropriate register for the transaction. Once the register is constructed and the advisors are comfortable with the final register, the book is closed and the investors are informed of their allocations, and shares are settled on T+2 basis.
Great, thank you, Sonya. Very thorough and very, very helpful. Now, I've got our final question here, and Izzy, I'm going to come to you on this one, if I may. And this is a question I think that you probably experience quite often, given your background and your work at Simmons Simmons. And I guess on the webinar today, we've got a lot of colleagues who are working within the real estate space. And I suspect this question is coming out really because for the first time, we're now contemplating quite a different approach. And the question is this: if I'm looking at IPSX, how is this so different to a private market sale?
So I think I mentioned earlier that if you're thinking of doing one of these, but you're a bit unsure, that the sort of earlier parts of preparing a company are actually not very different to what you would get on a bilateral disposal. So that does enable you to do a sort of dual track approach. I think after that, you get a bit of divergence between the two. So I think one thing to bear in mind is what Sonya sort of said about the universe of people who can buy interests in an IPSX company is much greater than the universe of people who have, you know, a sort of large check to go and buy all or half or whatever of a, you know, a substantial commercial real estate asset. So you may find that you've got different levels of appetite, and particularly if you've got a very large building, it may actually enable you to, you know, find a path to disposing of that may actually be more straightforward in a way. I think there's a whole, so leaving that part aside, in terms of sort of nuts and bolts, when you've got a bilateral process, you'll be used to the fact that, you know, you prepare it for sale, you've got some vendor DD packs potentially, you go and talk to a bunch of different people who may be interested, and then you whittle that list down, you move from a sort of indicative non-binding offer to something a bit firmer, you start to negotiate definitive sale and purchase documentation. And if you want to hold on to the asset, you've also got to think about, you know, some sort of joint venture agreement, shareholders agreement, something like that. And timing wise, you know, you're probably looking at sort of 2 to 4 months potentially, or if it's a long auction, it could take a bit longer than that. For an IPSX asset, I think generally timing actually not so different. You've got some specific timelines laid down by the UKLA. Overall, there's no real reason why it should be massively slower to do an IPSX float. What the difference is that you're not doing a bilateral arrangement with one other person. Your sort of other side, in that sense, are the book runners who will produce whose lawyers will produce a placing agreement, which agreement will contain essentially the terms and conditions under which they will procure investors for the shares and the various other things they're going to do. The main investment decisions are made off the back of the prospectus. So obviously that's a completely different document from a bilateral sale agreement. And the placing agreement is different as well in terms of its content, and even the nature of the warranties is a bit different. But it's all about making sure that you've disclosed everything that's required for someone to make an investment decision in the prospectus. And so that sort of element of the process is a bit different, but it's not a sort of completely alien process compared to doing a bilateral sale. There are lots of things that you will sort of see as being a bit different, and other things that you will see as being, you know, similar. So I think there's no reason, just because people haven't done one before and they're used to doing bilateral sales, to not consider doing this. But it does need to be something you think about sort of early. And as I say, it is very open to you kind of dual tracking up to a point as well.
Great. Thanks very much, Izzy. Now we've got one more question that's come in that I will just quickly take. And thank you to the person that has put this forward. And the question is, so, you know, how many issues have so far come to market, and have all the shares been subscribed? Lisa, would you like to just take that one?
Sure. So as I've mentioned on my slide, on one of my slides, we are now open to admissions. And the point of that is that we are a brand new stock exchange, only approved by the regulator, FCA, in January, and granted the recognised stock exchange status in February by HMRC. I can happily report that we have a number of issuers in the pipeline who have commenced the IPO process, and we're hoping to see those come formally to market by the end of this calendar year, subject to the wider environment behaving. So in answer to the specific question, we are open and we're welcoming new issuers to market, and we fully expect that they will come with all of their shares subscribed.
Great, thank you very much. And on that note, I should just add that if there are colleagues who are on the webinar joining us, who are thinking about looking at this very new way of a capital market transaction, please do get in touch. We're very happy to come and talk to you and to meet you and to set out for you how this will work for the asset that you have in mind. So please do get in touch. We're very happy to do all of that. So I'm now going to draw the webinar to a close. Thank you all very much for joining us this morning. And may I also thank Lisa and Izzy and Sonya for taking the time out of their schedules and joining us and going through such detail. As I mentioned right at the start, all of our webinars and podcasts are available free to download on our website at ipsx.com in the resources section. So thank you and have a very good day.